Here is part 4 of our Chapter 10 video lecture series, the last part of our Chapter 10, where the title of this section is called Recognize Gains and Losses. Possibly a better title for this section should be Recognize and Unrecognized Gains or Losses. Let's take a look at our gain and loss formula one more time, where we start off with the sales price of the property we're selling. Remember, this is all the different benefits, including cash that we're getting, possibly even other property we're receiving from the buyer of our property. And we subtract out the selling expenses. And in the case of real estate sales, probably the largest selling expense would be the sales commissions you pay the broker. And here we get now the amount realized, from which we subtract out the adjusted basis of the property we just sold. Adjusted basis was the topic of the previous video, part 3 of the Chapter 10 video lecture series. To eventually get a gain, if this amount realized is larger than the adjusted basis, or a loss if the adjusted basis is larger than the amount realized. And then again, the topic of our this video lecture is this gain or loss is either going to be recognized, meaning that if it's a gain being recognized, the gain is going to be taxable. We have to pay taxes on this gain. Or if the loss is reported, the loss is recognized, the loss is going to be deductible. Now, no one wants to suffer an economic loss, but we want the loss to be deductible because now we can subtract it on our return and save taxes. So the other situation for gain or loss is that they are unrecognized, meaning that if you have a gain, the gain is tax-free. Maybe this is the best situation for gains. Or another possibility is that gain is postponed or deferred. Remember now, we talked about realize. Yeah, realize means that the property was sold. Yeah. If you say unrealized, that means there's a potential yet. You haven't done the sale, you haven't done the exchange yet. But here, to be recognized, it has to be first realized. Now again, we're classifying it either as recognized gain or loss or unrecognized gain or loss. Now in the case of unrecognized losses, that means the loss is not deductible, non-deductible. And the most common situation here is for personal use assets you own. If you sell it or if it's destroyed, you cannot claim a deduction. It's only business or investment losses you can deduct. Or possibly a loss is going to be postponed again. Here I use the other word deferred until some other event happening in maybe a future year or future period. Okay, so let's take a look at some examples of transactions where you have recognized gains and losses and unrecognized gains and losses. So in our textbook, here's a situation called a wash sale. And probably the best form to take a look at to illustrate a wash sale is this form we've seen previously called a 1099-B, for which a stockbroker would issue out whenever you sell stocks or investments. So let's say I sold some XYZ company stock. And let's say it happened today. My today's date is October, I'm looking at my calendar here, 23rd, 2020 in our fall semester. And let's say the sales price is, how about $900 for that XYZ stock. But I bought it, here I bought it on this date, whatever it is. We'll talk about long and short-term gains and losses in chapter 11, our next chapter. But when I bought it, I paid $1,000. So sales price minus adjusted basis equals, in my case, a loss of $100. Let's add some more facts to this situation. Let's say that before this date I sold my XYZ stock. I had purchased some more XYZ stock within, let's say, 30 days. Or maybe even after the date of sale, I bought some more XYZ stock within another 30 days. So basically, what I'm doing here is when I sell the stock at a loss, I'm going to get a tax benefit, right? Because I get to subtract it out and reduce my taxes. But I end up in the same place because I bought some more stock here and over here. I still have the same stock and I now get to claim a loss. But this wash sales rules is going to prevent you from claiming this loss if you buy similar or same stock from the same XYZ company. Maybe you can buy ABC company, it may be in a similar industry, but if it's from the same company that's very similar type of stock, you're going to come into this wash, sale, loss, postponement rule. So if I'm buying and selling the stock with the same broker, they know I bought this stock, yeah, or I bought this stock. And I definitely they know I'm selling this stock here, yeah. And they're going to put the wash sale loss over here. And I cannot deduct wash sales loss when I sell this stock right here. I have to wait until I sell this stock or this stock. The way the broker keeps track of it is they're going to take this loss and add it to the cost of the other XYZ stock you bought. Now, this applies only if you buy the XYZ stock either 30 days before the date of sale or 30 days after the date of sale. Or in other words, it's a total of, in counting this sales date, 61 days if you buy XYZ stock and you sell XYZ stock on this date, any loss cannot be deducted right away. Again, we call this a wash sale. You don't get to lose the loss, but it's just postponed until you sell the other XYZ stock subject to the same wash sale rules. Yeah. Okay, so you might have a bigger loss next time or a smaller gain to report because of this postponed loss. Let's take a look at the next topic here in our chapter 10, which is the sale between people that are related. Here they say it's family members, like your spouse or your brother or sister, or your kids or grandkids, or your parents or grandparents, or even companies that you own and control. And the main thing here is the IRS doesn't want you to manipulate any type of gain or loss, shifting income to people who have lower tax brackets, and you get to deduct a higher, let's say, loss. Yeah, you cannot deduct a loss. Sometimes we call this a Section 267 loss transaction. If you have a loss because you sold property to a related party, the loss cannot be deducted. But then, if the related party sells the loss later on and they have a gain, they can use your postponed loss to the extent of their gain. Okay. Now, if your related party sells it at a loss, they cannot utilize your loss. That loss is really lost. Yeah. Now, you don't get the benefit of the loss. Again, the loss will transfer to the related person who bought your property. And if they sell it again at a gain, now they can use your loss to the extent of the gain they have. Let's take a look at another situation here. This one don't really apply too much. There's a type of stock if you are a founder of a company and you receive stock and you hold the stock for 5 years and you sell it at a gain, possibly 100% of the gain is tax free. What our textbook doesn't talk about is that this type of company, a Section 1202 qualified small business stock company, has to be in a certain type of industry. And the industries that don't count are restaurants, hotels, professional service businesses like lawyers, doctors, accountants, even agriculture. All of these make up probably the bulk of Hawaii businesses, yeah? So you don't qualify for this type of stock. Okay, let's move on to something called like-kind exchanges. So you remember now, let's go back to this gain or loss formula. So you're selling, you're giving up property, but maybe in exchange, what you're getting is not cash, but other property. This like-kind exchange rule applies to only real estate property that you're giving up and real estate property that you're getting back. So you don't have to report any um, realized gain or loss when you get back other property that's similar, like rental property, your landlord you're giving up and you're getting back a farm, an agriculture operation, or you're giving up an office building and you're getting back another office building. Now, if you have a loss, what you want to do is have the loss to be recognized. Yeah, you want to get that deduction. But if you have a gain, what you want to do is you want to, in this case, postpone the gain under this like kind transaction rules, like kind exchange rules. So you still have to go through this gain and loss formula. Again, we don't want to postpone any losses, yeah? We only want to postpone the gain. So what's going to happen, basically you're going to look at the cost of this property you're getting, basically the value included in the sales price, and you're going to put the gain over here, and you're going to subtract out the gain. Most times, of course, you would add gains, yeah? But in this case, you're going to subtract out the gain to get a smaller adjusted basis for that replacement property. So now you get to deduct a smaller cost if eventually you sell this replacement property. Or we'll talk about, again, depreciation next semester if we use this property for business purposes. Now, the form you would use to report what we call a like-kind exchange is this 8824. So here's a description of the property that you're giving up. And here's the description of the property you're receiving. And basically you go through that gain and loss formula here in the back side of the form, eventually figuring out the gain. Again, we don't want any losses here because we want to deduct the loss. And then eventually, if you get something extra besides the replacement property, you may have to recognize gain. Anything extra, sometimes we use the term boot. Like if you get cash back, in excess of cash you have to pay out. That excess cash you're keeping is boot, and the gain will be taxable to that extent. Again, taxable, recognized, yeah? But then maybe you get to defer, postpone. This is a different section here. Anyway, you'll go through this minusing out the gain on that form, yeah, from the cost to get a smaller adjusted basis for the replacement property. Let's take a look at the next section, next topic. Let's say we are going to sell your home. Here they call it principal, meaning the main place you own and live, yeah? You could have multiple residences if you're real rich, but we're only looking at the main one you own, probably the main place you stay and live, even though you have lots of vacation homes all over the world. And you go through the gain and loss formula, and for unmarried taxpayers, up to $250,000 of the gain is not tax deferred, it's tax free. Now keep in mind, because this is not business property, your home, personal use property, if you have a loss, the loss is not recognized, it's not deductible. Here we're only talking about gains. In the case of a married filing joint couple, if they qualify, up to $500,000 of the gain is tax-free. We're not talking about the sales price now. We're talking about the realized gain is tax-free. Now, to qualify for this gain, the taxpayers have to use the home for 2 years out of the past 5 years before they sell the property. Here they call it a use test. But using doesn't mean own. There's really two different 2 year tests. One is you have to use the property for 2 out of the past 5 years. And the second test is you have to own the property out of the out of the past 5 years before you sell the property. And both of these two, own and use, don't have to occur at the same time. Like maybe you can be renting the property, then later on you buy the property. Renting it is still using it, yeah? For a married couple to get this 250,000, only one of them have to be owning, but both have to be using it to qualify. So let's take a look at an example here. Here we have Lincoln, unmarried, yeah? So the maximum amount that he can exclude would be 250,000. So here's the sales price and the selling expenses. This is the same gain and loss formula we've been going through throughout this whole chapter to get the amount realized. Here's its initial costs and additional capital improvements to get the adjusted basis, to get the amount of gain realized. But how much does he have to report and pay taxes on? He gets to back out unrecognized 250,000, and he only has to report and pay taxes on 40,000. Kind of common here in Hawaii where real estate can appreciate over the years, yeah? So tell me, what would you recommend Lincoln possibly to save taxes? Do you know Lincoln is living with his partner or girlfriend in the same home, and he or she was living there for at least 2 years? Gee, maybe they should get married, and you can claim an exemption of $500,000, more than enough to wipe out any taxable gain over here. Let's look at our next section. Our last section here called involuntary conversions. In other words, accidents, disasters that you don't plan for. Maybe you plan for, but you hopefully don't expect it. Or possibly the government takes over your property because they want to run a freeway through your neighborhood. This is a gain or loss situation, just like you're selling the property. And whatever insurance proceeds you receive, whatever award the government gives you for the property is considered to be the sales price. Now, if you have a loss and the property is personal use, could be your home, could be your personal car, again, that loss is not deductible, at least under current rules. Usually, to have the loss to be deductible, it has to be business related, or in either business or personal use, it has to be incurred in a federal declared disaster, typically like a hurricane or a regional flood, maybe a major earthquake. Let's go through an example here. We have Dirk has an automobile. In this case, it's business automobile, and also it was damaged in a federal declared disaster. Okay, uh, because it's business, losses are deductible. Now, if this automobile was personal and it was related to a federal declared disaster, it also may be deductible. May, not necessarily will be. Yeah. So if you take a look at this automobile, here's the value of the automobile before the damage, and here is the value of the automobile after the damage. In other words, the value has decreased by 14,000, and the insurance proceeds he gets is 16,000, more than to cover this value. He's going to recognize a gain, but you don't use this 14,000 loss or reduction of value. Yeah, we still use the adjusted basis, minusing it out from the proceeds, which is acting like the sales price, to get a $1,000 gain. Now, this $1,000 gain, you're going to have to pay taxes. unless he spends all of this money to replace or repair his automobile. As long as he spends all of this $16,000, he doesn't have to report this $1,000 of gain. But if he spends, let's say, $1 less, he spends $15,999. He didn't spend all that 16,000. He has to report $1 of gain. In other words, if he only spends, let's say, 14,000 of that 16,000, and he saves $2,000 of cash and spends it on something else, he has to report all of this $1,000 gain. Okay, that's an election. He doesn't have to spend the money, but if he does, he needs to spend all of it to postpone or defer this gain here. Let's stop here, yeah? This is the last part of our Chapter 10 video lecture. Again, make sure you read the textbook. Nothing replaces that because that's what you're going to be using as a reference when you take the chapter quiz, and you're not going to really go through this whole video again just to answer questions on the quiz. Okay, so email me if you have any questions.